we're going to be doing today is starting the beginning of a series of webinars. And we're going to start off with market geometry. Okay, we have some of the basics on the website already, and I'm going to proceed and we're going to build around uh, trends and ranges, and we're going to expand over many weeks, learning about market geometry, market internals, what makes the markets work, support, resistance. We're going to go through all of that over the many weeks to come. Um, we haven't done much for IML in 2013 in terms of what I wanted to accomplish with the webinar series. I've been racking my brain back and forth, which is the best direction to go. And what I'm going to do is we're going to start off, and today is going to be extremely basic. All right. I'm going to come in assuming that we all know what a chart is, that we know what a bar is, but I'll run through a couple of things. But essentially, we're going to keep it basic today. I don't want to feed you too much for the fact that if I give you too much, you're not going to retain as much, and also it's going to be overwhelming. So what we're going to do is I'm going to go through step by step with the very foundation of technical analysis of trend, range, price relationships, and I'll give you at the end just a sketch out of what Elliott wave looks like. And I look at a lot at Elliott wave. We look at harmonics. I'll show you a little bit at the end about that, but I just want to keep it consistent over many weeks. And this is going to be the foundation, as I said. And then next week we'll come up with another and another and another. And I'll have a nice webinar series in the back office. But market geometry to me is an essential foundation of trading. I don't care if you're doing Forex, futures, crude oil, gold. It doesn't matter. If you like understanding market geometry and Fibonacci and all those mathematical equations, which is very simple, believe it or not. It just sounds exciting. So let's just get going and talk about what we're going to cover today. All right. We're only going to cover 5 different ideas today, 4 different ideas. We're going to cover trend. We're going to cover range. We're going to cover price relationships, what we call an A to B, C to D relationship. And then we're going to cover basic beginning of Elliott wave. In the future, we're going to expand on Elliott wave. We're going to look at lots of charts in Elliott wave, and then we're going to expand from that into harmonics. And harmonics are basically patterns that were discovered by a gentleman, Bryce Gilmore. There was Larry Presavento. There was some of the players out there, Scott Carney. They do a lot with both market geometry and these patterns. So the first one that was out there was called the Gartley pattern. And if you guys remember, a couple of months ago, we were doing that Wednesday webinar, and I drew out the Gartley pattern. Well, that's what that is. That was the first one that was developed. And then from that point, gentleman Scott, his name is Scott Carney, and I know him through the Market Technicians Association and the Association of Technical Analysis, and we've met on many occasions. And he's just a real good guy, real smart, and he's put together a book on market harmonics, butterfly patterns, bat patterns, crab patterns, and I even still to this day I look at his work, and you're always learning something. So one thing's important in the markets: always just seek to always learn. I've always looked at different big industry leaders in the markets. Always to this day, I've always learned, because you could always learn something, and you never stop it with the markets. That's the great thing about it. So let's talk about what is a trend. Okay, a trend is very simple. Let me just get my ink right here and get my little felt tip pen. Okay, there we go. All right, what is a trend? Most important, bottom line foundation of technical analysis, what is a trend? A trend, basically, as it says here, an uptrend is a series of higher highs and higher lows. What does that mean? Well, if we have a low here and the market went from, say, 100 to 110 and then down to 105, you had a low, a high, and then if it went from 105 to 115, you have a higher low right here. So essentially what the process is once you start developing these higher highs and higher lows, that starts establishing a trend. Now, if the market was going down in a downtrend, and then you have this occur, that doesn't necessarily mean that that's a trend up. That could be a correction in a trend down. What would establish the trend to turn from down to up, we would need to see the market come down again and then up again, where you would start establishing multiple high, higher low, higher high, higher low, higher high, and that would start establishing a trend. So depending if you're looking at the market from zero, you have to also look at the past and what the past data is telling you. And in this example right here, this example, it's telling you that the market was going down and that you're getting that, starting to get that process of the low, the high, the higher low, the higher high, higher low. And as that continues, you're establishing a trend. So, and this continues to create these higher lows. So this is a series of higher highs and higher lows, and that defines an uptrend. Conversely, a downtrend, you have your high, your low, your lower high, and your lower low, or LLL, lower low, and lower high. So what you're doing is you're establishing a trend down, or a downtrend. Now, typically when you're looking at a trend, the lower high does not exceed the prior lower high. And each low goes below the prior low, as you see here. So when the market makes a low, and then comes up and makes a lower high, and then makes a lower low, it needs to trade below that first swing low to start establishing continuation of that trend and establishing the trend. Now when the market does retrace up, it has to stay below this low and then continue to make new lows. So you're establishing what we call a downtrend. So uptrend and downtrend. Now later on, and in other webinars, we'll discuss Elliott wave, we'll discuss the components of Elliott wave, and that is really one of the foundations. If we look back at the old technical analysis, it all started with the Dow theory, okay? Dow, and that's a D, not a P. Dow theory, Theory, and basically the Dow theory said that a series of higher highs, higher lows, and lower highs, lower lows to establish a trend, and that the market should retrace a certain amount. But Elliott came in later on and started putting numbers and retracements and levels and zones and put structure around this theory. So this right here is a foundation of technical analysis. If you understand uptrend and you understand downtrend, you're ahead of the game. Now let me just erase all ink and put the felt tip. Now looking into the future of what we're going to be doing, not really today, but what we're going to be doing is a couple of things. Number one, we always look at this is the move up, and this right here is the retracement. Actually, let me fix the color. All right, let me fix the color here so we have a nicer color. What about that color? There we go. So here we go. So you have your low, you have your high, and then you have your higher low. This right here is called a retracement. Retracement, or it's called a pullback. PB, pullback. So if you hear the term when you're out in the market, because let's face it, we're in iMarkets Live. What do we do at iMarkets Live? We teach people how to make money in the markets. That's essentially the vision. That's essentially what we do, is we educate people how to make money. Yes, we have the signals, but what you do when you're speaking to somebody else, you also tell them that you're an educator. So if they ask you questions, at least you're going to have an idea of how to have a conversation if that person is market savvy. So we look right here, and this is a retracement. And that's what traders basically look for, the retracement. It's every trader in the planet, that's what they look for. They look for the retracement. Once they find the retracement, they look to take a trade. We did that this afternoon. We took a trade. We took one trade, it broke even. We took another trade, and it made a little profit. But essentially, we look for retracements. So these right here are retracements in a trend. Same thing as the bounces you see here in a downtrend. These are also retracements. Okay? And that's what we typically look at. So that is your trend, up and down. Let's take a look at another chart, and let's start identifying some of these trends. Okay, so we established the fact, if you look here, that this market was going up. Should I get rid of the red because now we have red all over the screen? Yes, I think so. Let's take a look and go with blue. So the prior move up was in a up trend, as you see here. You had a low, you had a high, you had a higher low. So we don't know exactly really what the data was in the past, but establishing the fact that this would be the high, and that would be a low, and then that would be a lower high, and that would be a lower low, and that would be a lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, higher low. So what ends up happening is the process probably went something like this. So your trend stopped going down once the higher low was in and started shifting directions back up. Okay, but during the course of this move from high to low, the first thing a trader does is look for the pullback. And you got your lower high, and they look for the pullback, and they look for the continuation. They then look for the pullback, then the continuation, then the pullback, and the continuation. So sometimes pullbacks are pretty, and sometimes they're not so pretty. And sometimes they're simple, and sometimes they're complex. Okay, this would be considered a complex pullback. This is basically a simple. A simple pullback would be, here's a move down, and here's your pullback, your retracement in a trend. That's a simple one. A complex one would be, here's a downtrend, here's a bounce, here's a failed test to try to make a new low, here's a bounce, and then a continuation. So this is a complex, and this is a simple. And this right here has to do with that Elliott, and so does this, essentially, and the Dow theory. So if you look here, that is exactly the same. That's a complex retracement, as opposed to this one. So two types of retracements, and that would establish this is what a downtrend looks like. High to low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, and continue down. And then the process of changing from downtrend going back up, you would have a low, and that should make a lower high, right? Because you're still expecting this to come lower, but it puts a higher low and starts the process up, and then the next move down, and then you start in that trend going from down to up. Okay, just like you saw here, same process. So sometimes it's pretty, sometimes it's not so pretty. But at least we understand what a trend, a downtrend in this particular instance looks like. Next. Okay. Now, an uptrend. What is an uptrend? Well, we don't, this may have come from down here, so if we say that this is a low, and this is a high, and this is a higher low, and this is a higher high, and higher high, higher low, higher high, higher low, higher high, and this is establishing that uptrend process. And that's what's happening actually right now with the markets, because this is current day market right here. It actually went and tested way up here already. I did that. Okay. So looking at the complex as opposed to the simple, let's just look at that again. All right. Here is a complex wave where you have your high, and then you have a process like that where the market doesn't just come down and go up, it comes up and then down again and then up again. And sometimes you see the same process like this, and you could see that. You're just following the structure of the market. But as long as new highs are made on every advance and higher lows on every decline, that's establishing an uptrend. And here's these little complex waves is what we were looking at right here. And you can see that happens a lot in the market. It happens an awful lot, which is actually good for traders. We like to see those patterns. So that's establishing an uptrend, and that's what the market looks like. That is the S&P E-mini futures. Let's take a look at the next chart. The S&P E-mini futures again, and this is going back several years ago. So I'm just picking some stuff out just to point it out. But let's think. Let's see what we got. We have a low. We have a high. We have a higher low. Higher high. Higher low. And you could just see the continual advance of new highs on every push up and the higher lows on every push down. So what we're doing is establishing an uptrend, and traders like to what? Buy the retracements. They like to trade the retracements because that's where all the money is. It's buying the retracements. Right? And this was written about 100 years ago. All right? And here's another one. Although it still made higher highs and came down, it still was above that prior low, so that remained and kept that trend intact. Right, so the retracements come in different ways. They look at different. For instance, here's a little complex wave as opposed to this one, but the fact is it's maintaining that trend, those higher highs and higher lows. Okay, that's considered an uptrend. We're still looking at that. Let's look at another one. I just want to go through each item, trend, range, price action, and then we'll look at Elliott, and then we'll have you initial structure to work with. So that way next week, when we come back, you'll have an idea of what we did this week, and then next week we can review what we did this week a little bit and apply to what we're going to do going forward. So let's look at an uptrend again. And to be honest with you, a vast majority of the people in the markets don't understand that that's up and that's down. The only difference is you have those little waves in there, which it makes it another downtrend. But a lot of people don't even understand this basic concept, and it's the most important concept in trading. So here's your low, here's your high, here's your higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. So that's establishing what we call an uptrend on that particular chart. In this example, there's a complex wave. And the reason I mention them is because we're going to have them in the future, and I'm going to get into that very deeply. So you do want to start, I want to start planting stuff right now to you. That way later on, when you look at it, it will make sense to you. That's a simple retracement. So you have simple as opposed to complex retracements. And as I said, traders, most importantly, look at these corrections, these pullbacks. So it's called pullback, it's called retracement. In technical terms, based on the Dow theory, which is a book of like 500 pages, they call it a secondary trend, which that's something from the 1920s. We don't have to worry about that. We'll just use modern day English. How about that? Okay, so now we understand what a trend is. So you have two things. You're either going to have expansion, like you would in the summer, everything expands when heat expands. You have expansion, or you have contraction. You have range contraction. Okay, when you have contraction, makes the market a little bit tougher if it's an extended or elongated contraction as opposed to a continuation. And I'm going to get into that in a moment. So what is a range? A range, basically, you're establishing a high and you're establishing a low based on prior swings. Okay, you're establishing a range high and a range low, and the markets usually stay confined within those ranges, and they start developing this sort of like a sideways, what we call a sideways line, just like that, where you could take a line and draw it through all through the bars, and you can see how many times prices trade through that. And a lot of times when you get in this type of environment, it makes it very difficult for traders because you don't know. It looks as though it's going to break to the downside and shoots up. Then it looks real bullish and it's going to go to the moon, and then it fails back down. And it's the time that you see it come down here and you think, it's going to go up, and you buy it and it goes straight down. And we saw that happen the other day. I think it was Monday or Tuesday, where the market, it was Monday, where the market had been going a long time for weeks. And then suddenly on Monday, market went down. You could tell a lot of people decided they want to buy it, and it flushed with fierceness to the downside, and it, what we call, trapped a lot of people. And when it flushed everybody out and they got out, it ran them back up. So in a trading range, it can be a real roller coaster ride, and this is what it looks like. So that's called a trading range, and basically you get testing and you get price bar overlap. There's two types. For instance, here's what a range would look like where the market's doing this. Price bar overlap is after the market has made a rally, each price bar would start to establish a sideways consolidation period. And if it's a trend up, this is what we call that pullback, right? You would get these multiple bars overlapping, or what we call price bar overlap, or a flaggish pattern for continuation. That type of range is different than this type of range, as you see here. So I'm going to show you some, okay? I'm going to show you some examples. All right, where would we establish our range? All right, we could see right across here, here's a range high. We can see right across here, here's a range low. We can see right across here is a range low. And we also have some stuff up here. So when we start to look at this chart, this is the most difficult type of market to work with. And you see it just goes and extends over days, all right? And because it's erratic, the market doesn't know where it wants to go. It's basically just zipping around like a pinball in a machine, bouncing around with no particular direction. It's a directionless market. And when you have a directionless market, risk goes to the moon. And believe me, I've entered in and you get stopped out because it fakes you. It makes you feel as though it's going to trend down, it's going to break. And because it's still in a range, it snaps back. And every trader on the planet has to gets in this kind of range, and sometimes they get excited that they're going to buy it because it's breaking out and it fails. And it's just a game. You don't know. Honestly, you don't know, but you can establish these range highs and lows, but you don't know the time when it's going to break out to the upside or break out to the downside, or it's going to fail. And that's the risk you have to take if you want to maybe take a trade. For instance, if the market came from this high straight down, it makes you feel that they're going down and they're going to continue lower, that they're forming a pattern for continuation. And what happens? It fails back up. This happens. So understanding what a range is, and that typically when you have a range, it's the most hardest trading environment, and that you want to identify this going forward in your own trading of is the market in a range or is it in a trend? Typically trends are the easiest and best ways to trade. A range is the most difficult. All right, all right. Here's another one. This one was on the 8th and 9th. Okay. You could see here. All right, so you're looking at the market and you're seeing this erraticness. And you're saying, how come you don't have any trades? You're saying to yourself, we all say that, there's nothing happening. Why? Where do you buy? Where do you sell? Do you sell here? Do you buy here? Do you sell here? It's just a spiky environment. As you can see, these little spikes, these are erratic movements in price, which really do not allow for profitability. It's the type of market, if you were to say you wanted to short it here because it's so fast, by the time you enter, it's here. By the time you look to get out, you're here. So this is a range, and I cannot stress it enough. You have trend and you have range. When markets contract, you have expansion and then you have contraction, okay? Markets end up doing this until they expand again, and then they contract and then expand. When you have this type of environment, just you have to be aware of that. So that's called a range. Now, this actually was part of a larger range up here, and you can see the market gave a nice shot to the upside, make it feel like it's going to the moon, and whoever bought it got stuck all the way back down, and whoever sold them got stuck on the way back up. So that's something to always pay attention to, what we call a trading range. This is an hourly chart of the S&P E-mini futures, and you can just see how the market acts in these tests. See these little tests? Okay, and that was actually that picture that I was just showing you, where it becomes erratic. It snaps out and then snaps back to the highs, and that's the type of market that you want to be aware of. A non-trending, rangy, spiky type of environment says to you either A, if you're going to buy and try to buy it here, you have to use a wide risk, or don't do anything, or if you're going to short them, you have to have a tight stop in case it snaps back up to you. All right, but most times you'll see a range have that price bar overlap, or that sideways line. So let me just show you. So if I take this line and come right across, you can see how many times prices traded through it. All right. So that's a trading range. When you could take a line, stretch it right across your charts, and you could identify many different times over many different periods. Look at this. This is actually since December up until even yesterday, how far this market has gone. It's gone nowhere but sideways and trading through that one sideways line. That's a sideways line, just like that. All right. So that's a note you want to make. So if you ever hear the term sideways line, you know what it is. Now you know what a trend is, and now you know what a trading range is. See, in a trading range, there's no definition of direction. You could just see this. See, so you could not tell if this is going to be the low, if the low was here, if it was down here. There's no way to tell because the market's erratic. Think of it as a ping pong, not ping pong, pinball. Okay. Okay. The next one we want to look at. The next one we want to look at. I'm not gonna make this a long webinar. I'm keeping this to the point, and that way we can establish our first little video and first webinar that's going to be the foundation for going forward. So a couple of things that are important, that are very, very important to technical analysis, is price relationships. What we call an A to B is equal to C to D. Now, on the website, there's a video I did. It's called Commonalities under the training section. And there's other complex stuff you can do with this, but just in its basic form of A to B equals C to D, I want to show you what it looks like. And this is what we call an alt. An alt A to B, C to D. All right. So what do we have? Let's just say A was at 100 and B is at 90. Or we could just say it's at 46 and 34, right? Hello. But let's just say that the market went up to 130, and this right here was 10 points. So this would tell you that this would be about 120 is an area that you would watch, that if the market came down and related in price here, that this would be an opportunity for you to trade. So when you're looking at the markets, we all have our demo platforms. You have the live educational room that we have up all day long. And for those of you that are in the live educational room, you get to see this stuff day in and day out, and you start to learn on your own and do your own trades. That's essentially what the goal is, to get you to start doing your own things and seeing this and making you a technician, where you basically, if you can understand this, you could feed yourself for a lifetime. I hope you understand that. So if you understand this, the basics, and you start to build upon that, you could feed yourself for a lifetime from the markets. Okay, it doesn't matter what any other kind of business you're in, anything you're doing. When you're receiving an income from either the markets or someplace else, you could trade it and create your own cash flow. That's the beauty of what we're teaching right now. And we do that every day. So you have your A to B, C to D. So you're looking for price relationships, equality between here and here. Also what we call an alternate wave equality. That's all it is. Alternate wave equality, where the market trades from high to low, from point A to point B, and then from C to D with the roughly, okay, how do I get it? With roughly the same length. All right. Now, if we take this, I got my dot there. Okay. Now, if we look at this in terms of an Elliott wave, all right, which we're not, and you say, okay, how does the structure really work? If we're looking at higher highs and higher lows also, here's your low, here's your high, here's your low, here's your high, here's your higher high, right? Here's your higher low, and here's your higher high. Now, I want to take it one step further. In the Dow theory, which we'll get to at some point, I'm going to go more into trend in the future. What it does also say is you have these higher highs and higher lows. Those are intermediate type of swings, and within that you have minor waves. So within the larger trend, you have smaller trends also making their higher highs, higher lows. So if you're looking at it, you're saying to yourself, okay, from here we should trend up, and you're still looking at these little trends, opportunities, all right? And then when you do get that pullback, you can relate it to the last largest one, which is this. Something we look at all the time. It's a lot of traders look at this when we're looking at Elliott wave, when we're looking at retracements. Those of you that like to look at Fibonacci, you take your low, you take your high, you put a retracement. Let's just say it's a 38% retracement, okay, for those of you that like Fibonacci. So if you start looking at a retracement zone plus your commonality zone of your price relationship, you start to work and develop yourself an area that you could feel confident that when the market gets there, you could buy it. Okay? And you know where you could put your risk points. Let's go to the next slide. Here's another one. As we discussed, here's a high, here's a low, here's a lower high, and we got that process of the trend down, right? Now we want to start looking at, and here's your little minor waves. Now we start looking at relationships of how to identify areas that you would look at as a trader. What are most important? Yes, it's great to say, yes, Chris, higher highs, higher lows, but where do you buy? Where do you sell? All right. So if you were trading this, and even if it went here, you may not have a complete signal because you didn't really have a relationship or a spot to watch. The only thing you could think of is maybe risk here if you're shorting here. Shorting means you want to buy it high and sell it lower, make a profit. Going long means you buy it low and you sell it high to make a profit. So what traders do is they like to look at these commonality zones where from A to B, and I can't see exactly this, let's just say this was 10 points, and you have a 10-point retracement here for C to D, you could feel comfortable that this is a very good area to watch, and you could put your risk quite a bit higher and feel safe that once you enter, you have higher odds to win than you would to fail. Not everything is perfect. You're not going to win every time. There's times you're going to get in, you enter, and you exit at the same price, or you may lose a tick, or you may gain a tick. But if you're identifying very good opportunities, very good zones, then you can feel more comfortable of a larger move. And that's what trading is, really. You're looking at something, you may enter here, you may get out. You may enter here, you may exit, you may enter here, you exit. It may go against you, stop you out, or may continue, but you're looking at the best areas, and in this case, that's why traders like to look at the A to B, C to D relationships, because if it went here, the last time the largest move was 10 points in a downtrending market, more odds than not, if it goes 10 points, that it's going to exhaust itself, that it's found 100% of that prior move, and that's what we call price relationships, okay? So it looks something like this. If we draw it out, okay, A to B, C to D. This is what we call an alt bullish, okay, because on the D area, you'd look to buy, so that's an alternate bullish. A bearish, it would look something like this. Like you do here. You see this? The same thing. You have your A, B, C, D, and you have your alternate bearish. That right there, this is an alternate bearish because you're looking to sell it to go lower. We have two types of waves, and this is one of them. This is the price relationships, the alternate wave equality, however you like to call it. That's what we call it, an alt bearish and an alt bullish, or an A to B, C to D. They all basically mean the same thing. And I always say you're always looking for D. You're always looking for D. If you're watching the live trading room during the course of the trading day, and we have a nice volatile market. The market started to pick up this week, which is nice. Now you're starting to get the patterns, and you'll start seeing a lot of these type of patterns just occur. Nice. That's what you look for, and that's where the money's made. You may go for days where you're doing a scratch, a scratch, a scratch, plus one tick, minus one tick, and then you'll get 5 points and 3 points, and then a scratch, scratch, 8 points and 2 points. That's how the market works. You wait for the patterns, you look for the spots, and when they occur, bang, you jump all over it. Okay, but sometimes it just you have to scratch it a little bit, meaning you're getting out in and out at the same price, plus or minus, and you're just always identifying spots to work with. As soon as it kicks for you, then you know you got the bull by the horns, because you know that this is a very, very key area. So I'm just trying to stress that the price relationships are really important. Here's another one. We look at this range right here. The market sold off. But if you take a look at the past, you can line up the equality of an A to B, C to D. Now, does this mean you're going to buy it? Does it mean you're going to sell it? No, you can just be monitoring the market and feeling that, if the market's trading lower, you could say to yourself, well, does this market feel like it wants to go a lot lower? Does it feel like a price relationship? If it loses this area, how far to the downside? But you can monitor spots that equate to prior swings. Okay, and you can draw your lines across there, and that's typically a lot of things that we do when we look at the markets. All this other stuff in between is kind of noise. Now, let's just look at something here. Okay, right here, we could just see, all right, you could just see almost that same type of equality. All right, how about this? This little swing here and that swing, almost literally about the same. You see that? So that would be considered an A to B, C to D, and that's an alt bullish. Remember? Down, up, down, what they call an alt bullish. So we've learned today so far is, number one, we learned what a trend is, both an uptrend and a downtrend. We learned what a trading range is, and we learned what price relationships are. So we've learned the basics, the basic fundamentals of technical analysis: trend, trading range, and price relationships. Because if we look at prior swings and we go all the way back, wow, I didn't know the ink stays there. Okay, let's just stop right here. Now let's look at this once again, and the market goes up and the market comes down, eventually starting that process of the higher highs, higher lows, right? And then it comes down right here, and as a trader, you look at it and say, wow, that's an A to B, C to D relationship. Let's okay. That would be an alt bullish A to B, C to D relationship. All right, so it doesn't matter where in the structure it is as long as it eventually happens. I'm sure at some point this one and this one has some type of a relationship, but I'm not going to go count it right now. But you could just see by eye that this one right here and this one right here, these swings were nearly identical. And price likes to relate in degree of trend. All right, price likes to relate in degree of trend. So, which means here's your daily chart. It's a very high time frame, and it's relating in that degree in that time frame. Now, for those of you that are already trading, that understand what I'm doing, keep in mind when you trade, when you go from, say, 1360 and the market has come down 10%, let's just say 10%, okay? Come down 1%. How about 1%? It comes down 13.80. It's up here. When it comes down 1%, it's $15 or $15.80. So if you have a market that went 20 points, for instance, here, say it moved 20 points, not necessarily on these larger time frame that 20 points will relate. What you have to look at also is percentage that the market retraced. So if it's traced at a real low price down here and it's moved so far up, you look at this in a percentage basis, not in a points basis. So for those of you that are traders, just something to keep an eye on and make a note of. But those of you that are not trading yet or watching the signal or just learning, don't worry about it. Okay, here again, this has actually happened just recently. We had the market all-time high and then made a low. Then the market made a lower high and a lower low, but it's not defining that downtrend. What would have defined the downtrend if this put a lower high and failed? That would establish the trend going from down to up. But in this case, the trend is where? Low, high, and then you have this A to B, C to D. It's funny, I say high. We have a guy who works with us. He does some graphics, and you get him on Skype, and he goes, "Hi, hello." So I say hi. I think of this guy. Imagine speaking to this guy at 11 o'clock at night. Hello. So hi. So we have an A to B, C to D relationship, and in the Elliott wave world, that would also be considered a high, an A, B, C. So although it still has an alternate A to B, C to D, it has a different structure, a different name to it. There's a couple different names you could put, but it's the same thing. All right. But most important, these price structures end up being the same length. So here's a trick also. The market was going sideways for so long, and then it broke to the downside. It gives you that feeling that the market wants to crash and all of a sudden spikes back up. So when you're dealing with these much higher time frames, you have to have a little bit of respect for it also. All right, and we were looking at some other areas when we were watching this on the opening plate video that we put out every day. So if you haven't been watching that, it's a very good idea to watch it. And it tells you levels that we're paying attention to. So now we know what a trend is, we know what a range is, we know what price relationships are, and now we're going to go to the last one for the day, and then we'll end with this, and then next week I'll expand on this and go into more complex stuff. So we'll do this also next week. So here's basically an Elliott wave. An Elliott wave gives you counts. You have a low, which is your 0. You have 1, 2, 3, 4, 5. After the 5th wave is completed, you have an A, B, C corrective wave. Let's stop and go back. No, let's stop and go back. Remember, low, high, A, B, C. Okay? Same structure that we have. And if you really want to look at it, you can identify these little higher lows in here. You can't really see it on this chart. It's just such a large time frame. And it was such an extreme move. But if we're looking at this chart, this Elliott wave, the count typically starts at 0, 100% of the time. And then you have your leg from 1 to 2. And as you recall, looking at trend, the trend is establishing an uptrend. Here's your high, here's your low, here's your higher high, higher low, higher high. Elliott, RN Elliott came in and says, okay, great, but let's put some numbers to it. Let's put some letters to it. Typically, a trend will go 5 waves. What that means is the first one is from 0 to 1. Then the correction, that pullback, is from 1 to 2. And then from 2 to 3, and typically that 2 to 3 leg is the longest leg. Then from 3 to 4, and typically 4 would not retrace more than 38%, and we're going to go into this on our next video when we talk about Fibonacci. And if you look at the video we have on the back of the website called the commonality video, you can see all sorts of stuff on the Fibonacci that I put together, but we're going to review it again on its basic form. And typically number 4 has to stay above number 1. That's the basic form, and that's also quote unquote that pullback. And that's also what we look at, is that alternate A to B, C to D. So if we look at this, this would be an A to B, C to D relationship, you see? So everything just works together in a trend. Everything just works together, all the numbers and lettering, and there is structure. So there is, somebody says there's no way to predict the market. Well, nothing's 100%, but it gives you better odds that you can have counts and waves and retracements and relationships that help you understand the market structure a bit better. Now, looking at the harmonic side of the equation, there's the Gartley pattern. This, for example, would be a Gartley pattern. Well, I'm not going to get into the percentages, but basically you have a low, or what we call an X. And it's still within this Elliott structure. If you really look at it, a lot of times it's within this Elliott structure or this this Dow theory structure. It's just that somebody else put their information to it. This guy Gartley basically found something that did like this. And that was it. He found this, he put it in a book on page 222 of his book, and somebody came up and said, wow, it's called the Gartley 222, and here's the pattern. So somebody smarter than all of us decided to do it and created a pattern and sold a book on it. All right, so this is called an X, A, B, C, D. If you're looking at this as a harmonic, in an Elliott structure, Elliott wave 0, 1, 2, 3, 4, 5, after the fifth wave, you typically will get that ABC corrective wave, as I showed you on the other chart. In a harmonic structure, you're taking the X and you're taking a retracement relationship from X to D, and you're also taking a calculation from A to B that also calculates down to D. And you're finding a zone that everything relates where you would enter on a buy and look to trade it. So there's different ways to skin a cat, different names. There's market geometry, there's market symmetry, there's harmonics, there's commonalities, there's clusters. There's whatever name you want to put to it. You can put your own name if you feel like. But the fact is, it's all based on Elliott wave. It's based on price structure, price relationships. And this is going to end our first week. It's about an hour, almost an hour. It's about 45 minutes. It looks actually about 52 minutes. So we're going to end our first week. Sorry, let me get a little bit of water here. I've been talking, I haven't stopped. And I'll put out an email. And next week, we're going to expand on the Elliott wave. We're going to expand and go through all different harmonic patterns. I'll get into some real good calculations and patterns and show you all the a lot of nice little tricks that you could take and use on your own, and help you also understand price structure again. So we'll go through the A to B, C to D's. We're going to go through them. We're going to go through the numbers again. We'll go through the price patterns, and once again and I'm also going to go through these little retracements and help you identify how to look at it like this. So got a lot that we can look at over the coming weeks, and next week's going to be our next part in this series. And with that, I have a 5 o'clock dinner with Bill, our Forex trader. I'm real excited he's on the team with us. He's got himself going Monday and Tuesday, and today it was nice and settled, caught some profits. I'm real happy about that. So we're going to see a lot of consistency from him. I got my focus solely on the futures side, and got a little profits today. So we're going to start picking everything up in that regard, and we're going to be teaching what we're doing more and more, and have a nice, clean, solid model that each and every one you could be proud of and you could take to the market and start building your business, both on the trading side, on the network marketing side, and just have a nice, clean model and keep the vision that we originally put together. And I'm just so excited about 2014. So make sure you're back next Wednesday. Make sure, if you can, get into the live trading room, get your signals up, and just get excited. The future is here. The future is now. And I'm just proud of each and everybody. I speak to a lot of you, and everybody has their ups and downs in life. But you know what? So does the market. The market's, although sometimes it looks like it's the worst, it's going down, and everything's crashing, it's the worst thing in the world. That's just the time to get started. You know, you have a pile of gold down here, and you're digging and digging and digging, and you feel like you're never going to make it. It feels like nothing's going to happen for you. And how many people quit an inch away from the gold? How many people don't buy the market an inch away from buying it? Okay? So the main thing is, just you have to have stick-to-itiveness in anything you do. And with iMarkets Live, we're here for the long haul. And thank you very much. I'll see you next Wednesday, 3 o'clock. Rock and roll. Have a great night.